When I woke up this morning, I had zero intention on filming a video today, but it's something I've been thinking about for the last little while, the last few weeks with the market drops that we've been seeing. I was browsing through some of the commentary on the Blossom app, and there's a lot of people out there, especially newer investors, who are probably pretty scared about what we're going through right now. And then, the markets are down again today, and there's been a lot of drawdown on the major indices lately. A lot of sort of financial bad news out there right now. I think of the tariff wars, the global tensions, these wars that we're seeing still out there. And the ripple effects of what we're going through now are just, shaking the markets all over the world. And with these dramatic headlines that we're seeing all the time, it's pretty easy to sort of feel like your investments, like your portfolio might be under attack. I want to just ask you to forgive me if this video is a little bit choppy today, because I didn't really have time to prepare for this, but I just wanted to share some of these key points. I understand what you're going through because I've been there. I spent 27 years as an investment advisor, as a portfolio manager, and I was so fortunate to work side by side with clients. And you've never seen it all, I guess, but I've seen just about every type of market turbulence out there that you can imagine over that time period. It was when the dot-com bubble burst way back in 2000-ish. I was there during that. I was there for the global financial crisis. Many of you watching this will remember that. And, every market correction, every crash since 1994, when I originally entered into the business, I guess what sort of has given me some knowledge, some wisdom, some expertise, is that I've worked alongside so many investors during some of the most stressful times that we've ever seen in the history of our markets. So I've lived this through not only my own eyes, but through the eyes of my clients as well. And here's one of the most important things that I learned. When we're going through times like this, it can feel overwhelming, but these are a normal, natural part of the cycle of investing. If you're a newer investor, you might not know that. You might have heard that sort of in the background, but this is sort of a reminder. This is a lesson that's what we're going through. And when we do look back over history, it is filled with periods like this, uncertainty. The key thing is that every single one of those times, the markets have stumbled, they've adjusted, then they recover. And that happens over and over again. So today I just wanted to take a step back with you and look at the bigger picture. And I want to sort of look at why this volatility isn't new and why a well-constructed portfolio, something I go over and over again on our channel here, is the best defense that you have, especially for newer investors. You can actually use these moments as valuable learning opportunities. The fear that you are feeling right now might be loud. The facts and experience, though, are even louder, and they will put those, they'll help you manage through those times. So I want to look at some historical perspective here. And this isn't, as I mentioned, the first time that I've been through this and seen a little bit of this panic in the market. Every single period of volatility, it feels like sort of that big one while it's happening. But time and time again, the markets recover. And as I mentioned, I remember the dot-com bubble in the late 1990s, early 2000s. I remember that vividly. And I was a young advisor at the time. I had worked in the business for only a few years. And back then, of course, tech stocks were the stars. And people were just throwing money at anything that had .com in the name. And it really felt like it was easy money out there. But then, of course, like it always does when there's a bubble, it came crashing down. And a lot of portfolios, and especially those portfolios that were not diversified properly, they were devastated. And I mean, they were devastated 80, 90% losses in many cases. There were too many investors who were just invested in tech. They were convinced that this boom that we were on would never end. There are memories, there are similarities to what we're seeing right now, and we have been seeing with all the money that's been flowing into AI without a real solid expectation or understanding or some foundation of why these investments will continue to go up and up and up. And we may be seeing, we're definitely seeing a pullback on that. We may be seeing a full-out crash. When that first crash, when I was in the business came, I was working with these clients and I saw the emotional toll that it could take. And we did have across the country, across the world probably, a lot of people who just simply sold out of fear. They thought, I can't take this any longer, and they suffered those huge losses. A key here, a lesson here, though, is those who stayed diversified those who resisted panic, they eventually recovered. And I would say they even went on to thrive as the markets rebounded over time. And that was one of the first real lessons that I had, the first real life lesson of the power of patience and diversification. Then the next sort of big one, there were hiccups along the way, but the next big one, of course, came during the global financial crisis. So I'm thinking 2007, 2008, early 2009. And things were different during this period. The fear, I think, was deeper because it wasn't just a market correction out there. It felt like the entire financial system was collapsing. I mean, I vividly remember, waking up, looking at the news on those days, and we didn't know if the banking system would even survive. And during those years, I remember sitting across from clients who were some literally worried about losing everything that they had. And it was very emotional during that time. I would say gut-wrenching to see the fear in a lot of people's eyes. Of course, like every other time, there are investors who over-leveraged themselves. They believed at that time real estate, financial stocks, were untouchable. And then if they were overexposed to those sectors when it all collapsed, the pain that they felt was very, very real. But here's what really stood out to me. The clients, in every case, the clients who had balanced, well-diversified portfolios and stuck to their long-term plans, without exception, they came out okay. It did take time, but the market eventually recovered, and those who stayed invested, they saw the benefit of that, having that well-diversified portfolio. I did also see the flip side to that, those who sold at the bottom, who were panicking, and they missed those early stages of recovery. And like a lot of these crashes, the recovery is very quick. If you sit down back and you wait till you see it's solidifying, then you probably miss out on that. And timing the market, as you've heard a million times, is almost impossible. And the cost of getting it wrong, if you're going full in or full out, it can be very, very expensive. So these experiences that I went through sort of drilled into my head that volatility is part of the journey, but the survival, getting through this, comes down to preparation, patience, and perspective. It doesn't happen now when you're in the middle of it and you haven't prepared. You need to be prepared. You need to have patience, and you have to put everything into perspective. Now, the most important thing that I'm going to talk about today is why portfolio construction matters. And I get it for a lot of younger investors who are watching this. I'm an old guy, and it just sounds like, yeah, boring, blah, blah, blah. You got to have growth stocks and everything else. And you do have to have growth stocks in your portfolio. But understanding that volatility is normal, it doesn't mean that you just ride it out and hope for the best. Preparation is the key, and that starts out with how your portfolio is constructed. I think of building an investment portfolio like building a house. You have to be aware of your surroundings, and you wouldn't build a house in an earthquake zone like we live here in British Columbia without reinforcing it. You wouldn't do that. And along the same lines, you shouldn't build a portfolio without considering how it's going to stand up against the inevitable shocks that we're going to see out there in the market. Now, I want to look at three specific things. Diversification, number one, is the foundation of your portfolio. This is not just something you read about in the textbooks or you see about on a YouTube video. It is something that I have seen save portfolios time and time again. And I think back to that .com crash. The investors who survived that weren't the ones who avoided risk altogether. You needed to be participant. You should have been, in my opinion, been a participant in that growth. But they are the ones who didn't put all of their eggs into that one basket. It's like it's about spreading investments across asset classes. I'm talking stocks, bonds, real estate, commodities. Within those classes, it means diversifying across industries, geographical regions, and company sizes. And we're not seeing enough of that today. I'll say an example here. You should have sector diversification. So right now we're seeing, tech. It might be booming one year, but it can also, of course, be one of the most volatile sectors. It can boom one year and crash the next. So if you balance that with holdings in the boring sectors like consumer staples, utilities, they tend to be more stable, and that can help cushion the blow when we see times like this. And every day when I look at my portfolio, I see stocks taking a hit, but on the other side, I see stocks that are going up because of that diversification, and it helps you ride through these times right now. Also, you need to have geographical diversification, and we tend to focus here on Canadian stocks or U.S. stocks, and that is important, but the global markets, they offer other opportunities, other risk profiles. So if you have a little bit of international exposure, however you get that also would save a lot of portfolios during times when the U.S. market right now is really lagging, the TSX as well. And lastly here, I'll say the company size diversification also matters. And a lot of people will go, well, right now you're seeing a lot of concentration on the large techs because those are the large cap companies, because those are those have been the driver. But you want to balance that. They offer stability, but a lot of small cap companies will also bring growth potential, but they'll also bring more risk into the portfolio. What am I trying to say here? I'm trying to say that a blend of different types, getting back to diversification, basically means that you're not overexposed in any one area and you're not subjecting yourself to a massive collapse in times like we're seeing right now. Now, number two here, I want to just sort of drive this home to avoid over concentration. And over the years, I saw a lot of investors who would fall into the trap of over concentration. We're definitely seeing that today. And normally this happens because investors are chasing hot sectors. Think tech back in 2000, think financials back in the great financial crisis. And now we're seeing that with AI. The key is this. If you're overexposed to one sector or one asset, you're taking on way more risk than you probably realize. So spreading that risk, that's what keeps portfolios going. That's what keeps them afloat when we hit volatility like this. So it does come back to diversification. And when you see how some people's portfolios are constructed in one or two or three stocks, times like this can really come back to haunt you. Now, number three here, this is really important. You need to know your own risk tolerance. And one mistake that I've seen over and over is investors who are overestimating their tolerance for risk, and especially during bull market. We can see that happen all the time. It is very easy to say I can handle the risk when everything is going up, or you might see a blip here and there. But what happens when the markets drop 20% or 30% or even more, as we see during the big crashes? That is when sort of reality sets in. And if the market dips that we're seeing now, if these bother you, if they keep you up at night, listen to yourself. That could be a sign that your portfolio may be too aggressive. Now, there's no shame in that. There's nothing wrong with being a little bit more conservative. It's not a manly thing to go and leverage up your portfolio with too much risk. There's no shame in having a properly constructed portfolio. Investing itself, this whole process, it should feel challenging, but it shouldn't be unbearable. And I saw that back in 2008, a lot of investors realized during that time that they really needed to dial down their risk just to sleep better at night. In the long run, if that approach helps you, if you can trim things back a little bit right now and you can stay invested instead of panicking and selling out at the worst moment, that will also go a long way to helping you be a successful investor over time. Now, I want to share a few words here, especially for new investors, if you're still listening to me at this point in the video. But if you are newer to investing, we're going through this very rough patch right now. It is very easy to be discouraged. This is something new, never happened before. But I would say, honestly, these are some of the best times to learn. And I was a young guy when I went through that first tech crash, and I learned a lot during that time. And investing, you have to learn, isn't just about riding the highs. That's the fun part, but it's also about learning how to navigate the lows. And we're seeing some of that volatility right now. So 5 quick tips I want to share with you here. First of all is study the market reactions. So you're going through this right now. Pay attention, watch how the different sectors respond to the news that we're seeing. Think about things like which industries are being hit hardest by the tariffs. Which industries seem to weather the storms better than others. So this gets back to building a proper portfolio. And, early in my career, full disclosure here, I guess, mea culpa, I didn't understand fully these dynamics, but living through them in real time, especially, in my case where I was working with real people, that helped me to develop better strategies for my clients and for my own portfolio over the years. And this is a chance that you're having right now to really capitalize on that. So there's a silver lining that can come out of all the volatility that we're seeing right now. Now, number 2 is focus on the long-term goals. And that's easy to say. You hear that over and over and over. But I remember back when that tech bubble burst, there was a ton of people who panicked and they sold off and their portfolios were crushed. And I would say unnecessarily. Those who stayed focused on the long-term goals, who didn't react to that short-term noise, they eventually recovered. And investing is about looking, 5, 10, 20 years ahead, and certainly not reacting to every headline like we're seeing a lot of those today. And number 3, you heard this over and over again. These aren't my ideas. These are time proven. Don't try and time the markets. And this can be a pretty hard lesson. In 2009, I knew investors who literally pulled out at the bottom, and they said that they would wait until things improve, wait until things look better, got a little bit more stable. As so often is the case, by the time that happened, they'd missed a lot of the recovery. So again, timing the market is nearly impossible. It doesn't mean you can't tweak your portfolio along the way. I do believe in that, but full in, full out, I don't think that's a good strategy. I think consistent investing, no matter what the headlines are, is often usually the smarter move. Now, number 4, dollar cost averaging. Again, I know a lot of people do this, and this strategy saved a lot of my clients over the years, both financially, but also just psychologically as well. If you invest the same amount regularly, you buy more when the prices are down. You buy less, of course, when the prices are high. But one of the key benefits here, it helps remove the emotion that so many people are feeling today, and that can build steadily. That can build your wealth steadily over time. One of the first sort of eye-opening real-life lessons that I learned was those who dollar cost averaged throughout that tech crash, they went down for the ride with everybody else, but their portfolios recovered so much quicker than those who simply, held tight and wrote it off. So if you wrote it out and then didn't add during the time, if you dollar cost average during that time period, and pretty much every time like this, that can turn out to work in your favor as well. Now, the 5th thing here is just to reflect and rebalance. As I mentioned, volatile times like we're going, this is the perfect time to reassess yourself as an investor, to look at your portfolio. Are you too exposed in one sector? Is your risk tolerance aligned with your current strategy? You're going to learn a lot about, you should hopefully learn a lot about your risk tolerance right now, your real risk tolerance, because this is the time when you learn, and a lot of investors can sort of be surprised to realize how much your portfolios have drifted over time. And you always hear about rebalancing your portfolio. It's hard to do when the markets are going up and up and up. It's hard to take those profits, but it can really help to keep things on track. Nobody enjoys market downturns like this, and I have sat with countless investors over the years who felt when their portfolios dropped, they felt that gut punch that so many of you are feeling right now. And it's interesting. I look back at certain clients, and it wasn't just one time it happened and then you learn your lesson. Every single time the markets dropped, that's the way you would feel. It's tough. What I do know from my experience, though, that these periods do not last forever, even though sometimes it might feel like they might. We have that short-term extrapolation where we feel that it's always going to be this. The markets will fall, they're going to shake it off, and then they will rise again, time after time. So the key is preparation. Simple as that. A diversified, well-balanced, well-constructed portfolio is kind of like having a life raft when you're out there in the waters. You're going to feel those waves, but you're not going to go under. For newer investors, this is a chance to build not just wealth, but investing wisdom. This is a real opportunity we're having right now. So I guess the last thing here, when the headlines feel overwhelming, like they might be now, just sort of take a breath, step back, trust in your long-term strategy. If you have a long-term strategy, if you understand what you're doing and building your portfolio, and just remember that this too shall pass. Thank you very much for watching. Invest wisely.